Thank you. Kathryn.
Good morning. I'm here to talk about two of the more colorful countries in the region, Venezuela and Brazil. I think I'll start with Brazil. What an amazing fall from grace we've seen, from this market darling to market bear. This is the country that everyone loved and couldn't get enough of. I remember working for the portfolio manager at my first job, and we maxed out exposure to Brazil at every possible turn. Brazil was the place everybody wanted to be. So now we've seen a remarkable, as I said, fall from grace, and less than 10 years. What I'm expecting is Brazil to see its third consecutive year of recession in 2016. We're talking about inflation with recession. So inflation finishing this year in the double digits at 10%, and that likely to unwind and recede towards 2016. Still a very complicated scenario from the economic picture in Brazil, and very unlikely, a very complicated scenario in Brazil. And I would say it's not just due to exogenous shocks, because many people say, okay, Brazil is a commodity function, it's a derivative of China. It's not just that. So I'd like to look at a few of the factors that, in my view, have led Brazil to the point it's at right now, which is a severe loss of confidence, a big hit to market credibility, both on the institutional framework side, on the monetary policy framework side, and on the fiscal side. So what are the few I would call self-inflicted wounds over the past several years? Well, more recently, we've seen government-controlled prices, big amounts of government interference in the private sector. We've seen the controlling and capping of prices in a misguided, in my view, attempt to improve the economic scenario, to bring down rates of inflation. So capping electricity prices, capping what Petrobras can charge for its energy, putting basically administered prices on many sectors of the economy. What has that done? So counterproductively, of course, as much government interference does, that has to be unwound at some point. So it's not something that's permanent. This year, we're seeing inflation at 10%, breaching that 10% year-over-year pace of expansion, precisely driven because of this unwinding of administered prices. So I would say that was a counter-effective policy. And electricity prices this year are up 60% year-over-year, and it's been a main driver of inflation. Second, I would say, is whitewashing of fiscal accounts. So not only has this not reached its goal, which its goal was to avoid rating downgrades to below investment grade, but actually it's going to both bring on rating downgrades to junk status across the board, in my view, and two, could very well be the primary reason and the primary end game for the impeachment of the president. So this, in my view, there's two ways they can go. One is the fiscal backpedaling route, and one way is the campaign financing route, irregularities therein. I would say that at this point, precisely this attempt to whitewash the fiscal accounts is going to be the president's downfall. We at Baltic have held for a very long time that we thought impeachment was a very high risk. I've said it's above 50%. Publicly, and I think that it's well above that at this point. So that's number two. Number three, I would say, is fiscal maneuvering is actually going to make fiscal counts worse, because once the auditors come in and say, hey guys, you have to put this on your books, you have to pay back the banks, you have to really clean this up, we're going to see even worse fiscal numbers going into 2016 and 2017. For, I would say, loss of monetary and fiscal credibility. Back in 2010, 2011, when inflation was averaging above 7%, the central bank took the Selic down 525 basis points, losing, I would say, a great amount of monetary policy credibility. Over the course of the past 5 to 10 years, we've also seen capital controls coming on and off, which isn't a good sign for private investment. It doesn't bring confidence to markets. So that impacts portfolio flows and potential for them. And fifth, of course, is Lava Jato. It's the big corruption scandal. This has brought both consumer and business confidence down to record lows in Brazil. And this has been a heavy weight, not only on, as I've mentioned, portfolio flows, as actually portfolio, I would call them outflows, as everyone heads for the door from Brazil, but also in terms of domestic demand. Domestic demand has been a primary driver of Brazilian growth over recent years, and that has absolutely collapsed. So until there is some resolution, maybe touching the bottom in terms of this widespread scandal that seems to be enveloping all aspects of the real economy, many companies, even CEOs of BTG Pactual, Odebrecht, potentially even upper-level people in the administration, until the market sees a bottom there. This is going to continue to weigh both on Brazilian risk, as Franco said. We're market economists, so we like to look at Brazil from the perspective of investment and interest therein and possibility for upside. But there's still going to be that weight. I would say this is going to carry over into 2016 and is part of the reason why I continue to see a recession for the third consecutive year in 2016. Now, recently, last week, we saw, as I mentioned, BTG Pactual CEO arrested, put in jail with, as Bloomberg reports, with the rats and shaving his head, and kind of treated as the worst of the common criminals. Pretty shocking, as I said, fall from grace and change in Brazil. A lot of these white-collar crimes, a lot of this government whitewashing of the fiscal accounts was common practice, I would say. Even the government said, hey guys, the backpedaling, the pushing this through without congressional approval is something that's been going on for a long time. Same thing in the case of the corruption scandal. Now we've seen the government make very clear that that is no longer the case. So I would say that that's an important point to make. One thing that came out yesterday, last night actually, from the vice president was some very colorful words for his relationship with the president, which, apart from being kind of part of this telenovela saga that we've seen in Brazil, in my view, really is almost a mortal blow for the president, because it tells me that the PMDB, which is critical for the support of the president in both in the Congress, in policy making, but also in the impeachment process, is really flailing. Now, there's about 63 seats in the Congress that are comprised of PMDB. She needs the PMDB both to survive and for governability. I would say her governability at this point is virtually dead. And I would say that the loss of support from PMDB makes the impeachment look far more likely. The PT has about 53 seats, and the PSDB, which is going to vote against Dilma, something around 50. So I would say that this is going to be a theme for the markets. Once impeachment does look more likely, and it seems like it will be a speedier process rather than a prolonged process, the market will rally. I think this would be a very positive sign from the market's perspective, and we will see Brazilian assets rally as a result. I think change of management, anybody but Dilma's approval ratings are below both the rate of inflation and the fiscal deficit. Just to give you an idea, her approval ratings are at 8%, inflation's at 10%, fiscal deficit nominal is verging on 10% as well. And I do think that that second rating downgrade is imminent. I would say Brazil is going to, in the next 3 to 4 months, see a junk rating across the board, Moody's, S&P, and Fitch. And I think that a lot of that is already baked into prices at this point. Just to give kind of some market views, in late September, we looked at the 10-year benchmark Brazil. We said, how is Brazil, with $380 billion in reserves, trading cheap to Honduras? Franco, Honduras is what, single B?
Yes.
Yes, single B. So Brazil, in the worst case scenario, gets across the board rating downgrades to junk, but at the top of junk status. We don't see Brazil moving down to single B. We don't see it moving down to double B, not with the war chest of reserves and not with the improved debt profile. Now, from the sovereign perspective, you see a different situation from the corporates. Brazilian corporates have certainly levered up in US dollar terms, taking advantage of low interest rates and really capitalizing on that, making the corporates harder hit as the dollar appreciates. At this point, the sovereign, however, has a majority of its debt servicing in local currency. So that gives Brazil a little more bandwidth in terms of vulnerabilities. So I think with that, I'll turn to Venezuela, the other, I would say, tragic comedy with a potentially very happy ending. Venezuela is obviously lodged in an unsustainable deterioration economically with, by our estimates, over 250% inflation, likely recession of 8 to 10% this year. Scarcities that are inhumane, and it's actually a humanitarian crisis in Venezuela. I would say that the victory, the landslide victory that we saw over the weekend is testimony to the fact that this was socially no longer acceptable. So the landslide that we saw by the opposition, in my view, can very well bring a transition, a rebalancing of power at least. So at this point, with the supermajority, the opposition has far more power than ever. At this point, what we can expect is instead of an absolute control of all branches of government in Venezuela by Chavismo, which, by the way, has been the main culprit for Venezuela, or kind of like the textbook example of what not to do with an economy, right? So every type of control you can imagine, price controls, capital controls, controls on private investment, really reducing private investment in Venezuela to zero, I would say has finally turned the tide. What can we expect? Definitely pushback, right? So an attempt to pack the Supreme Court before the opposition takes over, or attempts to degrade or take away some of the power from the National Assembly is a given. Chavismo has done a very good job of self-preservation over the past recent years, especially since Hugo Chavez died. But I think it's going to be important to realize that the supermajority does allow approval of budgets, no confidence votes on cabinet heads, election of central bank board members, Supreme Court justices. This is a very big change in Venezuela. I think it's going to be important for the opposition to maintain unity. The opposition has definitely different fragments and different extremes, but I think we can expect a few things. One, more attention to the unification of this wild, multi-tiered exchange rate. At this point, we see the official rate is a joke, really, at 6.3, and that's bleeding the fiscal accounts for Venezuela. It's absolutely bleeding them dry. And it lends itself, obviously, to corruption, over invoicing, and government cronies really gaining enriching themselves quite a bit. So we can expect some approach to consolidating the FX. I would say it's potentially increasing the gas prices, some more interest in private investment coming into Venezuela. I would say these are some of the things that we can expect over the course of 2016. It's going to be a tough road, 2016, despite the collapse in the economic activity that we're expecting for 2015, is likely to see a similar contraction, not to the same magnitude, but regardless, economic contraction in 2016. But I do think that this is an important sign for the markets of a potentially more market-friendly, not potentially, definitely more market-friendly administration in the near term. One of the things that caught my attention over the past couple of months is some opposition economists talking about potential restructurings. So that's one thing that we're going to be looking at. At Baltic, we held for 2015 there would be no default, and that certainly played out as expected. We maintain that the willingness is intact to continue to service debt. One thing I will mention is what we've been looking at is the absence of collective action clauses on nearly all PDVSA bonds, on a couple specific Venezuelan sovereign bonds. But the interesting thing is when you look at the debt servicing and amortizations and redemption for 2016 and 2017, it's pretty moderate. I mean, as Alberto mentioned, if oil prices go up, which is our expectation, then Venezuela is in far better stead in terms of the capacity to service debt. I think willingness remains. But yeah, there's one debt servicing payment coming up from the sovereign perspective in February. We hope that they make it. And then the next big payment is coming up in the second half of 2016. So our contention is that oil prices do find a bottom, stability, and move higher through the end of 2016. So we are more bullish in terms of Venezuela. This is going to be an uncertain road, a rocky road, inherently volatile, but we think that there's there's more upside with an opposition-controlled National Assembly and the capacity to really engender real reforms at a structural level, given the supermajority that they have, versus same as always, road to nowhere from Chavismo.
Well, thank you very much. This is one of our first forecasts in a while where there are a number of countries. What? Closer? It's going to be in my mouth. Where we've had a number of countries that have turned around, at least economically, or will be turning around. Our political panel, which will be the final panel, will go into more detail on the political issues involving these Latin American countries. So in the meantime now, first I want to thank the four panelists for all excellent presentations.